Hello and welcome to the BizNews Breakfast Briefing. I'm Lucy Ferreira for BizNews.com. Continuing our focus on local banking and resource stocks today, we hear from Piet Viljoen, manager of Counterpoint Value Fund, unpacking the pummeling that JSE-listed mining shares have taken this year, and how to assess your own portfolio for potential permanent capital losses. Piet also touches on a handful of appealing stocks in the market at the moment. We then hear from globally respected banking sector investor Kokkie Kooyman of Denker Capital, looking at whether or not value can be found in banking stocks at their current levels, and why smart money might be looking hopefully toward the possibility of a business-friendly ruling coalition come the 2024 elections. We then end off the show with the daily news update from our partners, the FT in London. First off though, as usual, we have Alec Hogg with his expert analysis on the markets.
Thanks, Lucy. Good morning. It's Wednesday, the 20th of July. I could actually let the cheering run quite a long time this morning. The S&P 500 index up 2.8% last night. The Nasdaq up 3.1%. Those are the best numbers that we've seen from the markets in the United States for over a month. And the reason for this is that there is concern amongst many money managers now that they might be left behind. Research that came out yesterday from the Bank of America showed that the professional investors have got their lowest allocation to shares at the moment since 2008. So it's almost like as the share markets have fallen in the United States, and we know they've been under a lot of pressure this year, the money managers have all been selling into the weakness. Not a good strategy because it's the herd instinct can work when you're in the middle of the pack sometimes, but when things turn around, it means you could be left behind. And as a consequence of that, there's some concern. The other bit of good news for American shares was the slight decline in the US dollar index. It's at a 20-year high, and when the dollar is strong, it affects the earnings of the international companies that are listed on Wall Street, what they get in from other parts of the world. And so we've seen, for instance, IBM's results came out earlier in the week, and IBM's share price was down again yesterday after analysts went through the numbers again and saw, well, the strong dollar is really affecting the profitability of IBM at the moment. And there are many other companies in the same boat. Netflix's financial results were released last night. And actually, they did better than the street anticipated, even though Netflix lost 1 million subscribers. This was better than the 2.5 million that had been projected at the last quarterly result. So at last, the Netflix team have got something to celebrate. You might recall that in the past two quarterlies, Netflix has disappointed the market. Last night, however, the results made people pretty happy, and Netflix's share price was up by 5%. Against all of this, the rand strengthened a little against the US dollar. It was 4 cents stronger, but it gives you an indication that it was really about some dollar weakness as against the rand strength, because the rand lost 13 cents to the pound. We're at 17.09 to the dollar, 20.57 against the pound, and 15 cents lower at 17 Rand 50 for each euro. Bitcoin continues to steam ahead, another 5% overnight. It's now trading at the moment at $23,335. The Brent crude oil price up by $1 to $107 a barrel. And here in South Africa, the JSE All Share Index yesterday rose by 1.25%. And it's interesting to see that some of the movers were the smaller cap shares. A big increase in the share price of, for instance, Grinship. Now, this is the second day in a row that Grindrod Shipping was up strongly. It gained another 9%. Month on month, it's still fairly level to where it was a month ago, but it is rebounded very sharply in the past couple of sessions. Cashbuild up 7%, Supergroup 6.5%, and Borwin Properties up 6%. Those are not the kind of names that you often hear us talking about in this market report. So it's those second line companies that are now starting to get a little bit more attention. the companies that someone like Piet Viljoen says are very cheap. The Geltech basket, with the increase in Bitcoin, that's doing better. It's now at 434 Rand and 44 cents, up 2%. And even the gold price has got some reason to celebrate. That was up $4 overnight. It's now sitting at $1,712. But all the action really on Wall Street, looking at Netflix and what happened there. The improvement in Netflix also went through to other shares on the market. Some of our favorites had a good session. Amazon up 4%, Apple 2.5%, Microsoft 2%, Tesla 2%, and Meta 5%. And then there's a stock in our portfolio called MicroStrategy. Now, you might recall that we put this share in the portfolio as part of the Bitcoin exposure. We've got the Pro shares, Bitcoin Pro shares, as 1% of the portfolio now, and MicroStrategy as 1% of the portfolio. Reason being that MicroStrategy is the company that owns more Bitcoin than any other company listed on the New York Stock Exchange. And because Bitcoin has been going up, MicroStrategy has been zooming, and last night it was up 18.5%. We're still like 35% down on the entry level, but at least there is some hope on that one.
And now it's over to Alec Hogg's interview with Piet Viljoen.
A little bit of upbeat music for a man who's in top form. Piet Viljoen is the portfolio manager of the Counterpoint Value Fund. Since March, resources shares, of which you have quite a few in your top 10, Sibanye, Exxaro, Anglo, Goldfields, they have come down pretty sharply in that period. Is this just part of the volatility, or is it something maybe that would change your mind about what you should be owning?
If one expected this sort of knock, you probably wouldn't have owned them 3 months ago. You probably would have sold them. So I can't say I expected this sort of knock. But yes, one expects this sort of volatility from time to time. You just don't know when it's going to happen. That's the thing. But it does happen from time to time. Share prices go up a lot sometimes, like they did last year and up until March. They went up a lot. Nobody calls it volatility, but it's also volatility. And now they've gone down a lot, and now it's volatile to the downside. I would point out one thing, that net year to date for the first 6 months of the year, despite the downdraft in some of the resources shares over the past 3 months, the fund itself is still up 1.5% for the year to date, which I think relative to any index and most other funds out there is still a good performance. So yes, there has been some downside, but before that there was a lot of upside. So the downside is not as bad. But I think one should focus on, does this downdraft represent a permanent loss of capital, or is it a temporary loss of capital? I think that's the key aspect one needs to think about. So if one thinks about that, when do you face a permanent loss of capital? And I guess there are three things that you need to think about in terms of that. The first thing is, are you invested in outright fraud? Because then you can face a permanent loss of capital, something like Steinhoff or Tongaat or that sort of thing. That's a permanent loss of capital. You're not making that money back. That's gone. Is it a growth bomb? In other words, a company with very high embedded growth expectations where the underlying reality does not match that. So the share price reflects the expectations and the underlying reality doesn't reflect it. And then you can lose a lot of money on a permanent basis. You're not making it back. Something like Naspers would be an example of that up until about 9 months ago. Possibly Netflix as well. A lot of the FANG stocks were just, they had very high embedded expectations of them. Good businesses, but they couldn't match those expectations fundamentally. So that represents a permanent loss of capital as well. But those are just like examples, and there's many of those sort of examples. Growth stocks which are priced too richly. And the third one is these value traps, where you buy a cheap stock, but it just stays cheap forever, and it possibly goes down as well because it doesn't create shareholder value. So those are the three types of stocks that could cause you to lose money on a permanent basis. And I think when one looks at your portfolio, you should look at and see if you own any of those. And the clue as to whether you own any of those sort of stocks is cash flows and balance sheets. Does the business generate strong cash flows, or does it have a solid balance sheet? if you can tick those two boxes, then a decline in the share price in the short term represents a buying opportunity. It doesn't represent a permanent loss of capital. But when there is a lack of cash flow or very stretched balance sheet, then it could represent a permanent loss of capital. The whole thing with Steinhoff was always that there was never any cash flow. There was always a question mark around Steinhoff. There was never any cash flow. And resource shares in 2014, 2015 had very stretched balance sheets. So when the commodity prices came down, they made losses, big losses, and had to issue equity, dilute their shareholders. That represented a permanent loss of capital at that time. Today, if you look at the top 10 shares and say the Counterpoint Value Fund, there's one common denominator. All those companies have very solid balance sheets and are generating very strong cash flows.
It's an interesting point on this one, Piet, because similarly with banks, and I see you've got three financial services
That's
companies
correct, yeah.
in your top 10. They seem to have much stronger reserves today than going into the last recession or the last global economic slowdown.
Exactly. The bank's capital asset ratio are running 12, 13, 14%. Lots of the banks are sitting with excess capital. And I think it's not inconceivable that one can even expect some special dividends in the future coming from some of these financial services companies, including the banks. So solid balance sheets, generating good business, possibly not growing as much as they could, but that's a free option to the upside. If they start growing, then I think you could see some good price action. Who knows whether that will happen or not. But the fact that the share price has come down does not represent, in my books, a permanent loss of capital because the business is sound. And if you go through all the resource shares, they're trading on multiples of 3, 4, highly, unleveraged balance sheets, cash on the balance sheet, generating cash flow yields of 20 to 30%. So that'll come down. As commodity prices come down, those cash flow yields will come down, but they're still generating positive cash flows. Sasol oil companies are discounting oil prices of $65. So the oil price comes down from 120 to 100, and the Sasol share price comes down. It's still making tons of money.
Next up is Kokki Koiman.
So bringing it back home to South Africa. The last time we spoke, I got so excited about what you said about Absa that we added it to the BizNews portfolio, and it's done okay. It's actually gone. It's ahead of where we bought in. Is that still the kind of stock to hold? And I'd like to kind of unpack this in something that Piet Viljoen was saying, because he has Absa, Sanlam, and FirstRand in his portfolio, in his top 10, those three. And he says that FirstRand and Sanlam are well-managed, great entrepreneurial culture, and something that the market doesn't believe will continue, but he believes will continue. So put that one side. And then Absa, on the other hand, he says has been badly managed, but is now being well managed for a change. Your thoughts on those points?
Yeah. So a bit of spot on there. FirstRand is just such a fantastic, well-managed business. And it still comes back from the founding ethos of Laurie and GT and later Paul Harris, those three guys, the whole, and then Johan Berger. And there's such a culture that was generated and in the guys there, and the way they do things and the way they think, and then it starts working for you. So FirstRand return on capital of about 20%, and there's a high degree of certainty that they will deliver that for the next few years. So if you think back just to how do you think about investment, you want three things. You want a good valuation, you want good growth, but you want a high degree of certainty. And FirstRand, through their track record management, gives you that certainty. Now, Capitec, FirstRand trades at 2.5 times book. Capitec now trades at, relative to its past, cheaply 5 times book. So, but for Capitec, you need an even bigger degree of certainty, which the market has, that because it's trading at double the valuation as FirstRand for almost the same return on capital. So the market is saying they're going to grow that profit stream at that rate for much longer. Absa is trading at 1 times book. And Absa, the current team, I think, have done a lot of work, and they started that 4 or 5 years ago when they did the big turnaround, did a lot of introspection, looked at where they lost market share and set in practice new operating ways, new marketing strategies, and that's coming through. So the return on capital of Absa is coming through. So I agree. It's also one of our biggest holdings, also FirstRand, and then Investec, and then Absa. Investec is also a team really done well in turning a business around that was, especially in the UK, floundering.
Perhaps I'm being simplistic on this, but if I'm buying Capitec today, they would find it much more difficult to go from 5 times book to 10 times book than Absa would from 1 times book to 2 times book.
Absolutely. So Absa could, in a very good scenario, if let's say our government comes with us. Unfortunately, a lot of things in South Africa do depend on the government. They come with a big plan and say we're going to do this and this, and our GDP growth goes from 2 to 4%, and then Absa, just on that macro scenario, uplift could go quite easily from 1 times book to 1.5, 1.6. And then as the environment improves, loan growth comes through, then the return on capital could quite easily go to 20. So that's why most investors in South Africa have started adding Absa, trusting that management will do well. So there's a big responsibility there on the board. Selo, who's taken over as chairman now, to make sure that as a board they keep that management team focused and incentivized to deliver the results.
You've opened a door, which is something that we've been exploring at BizNews. Post 2024, a new coalition government with a different economic policy to the ruinous one that we've seen for much of the past 28 years. How would that be interpreted, and how, if that were to eventuate, would that impact particularly banking shares?
The low-hanging fruit in South Africa, if the government was to engage with the private sector, is just so massive. Just think of the capital needed to recapitalize and put Transnet, to put SABC, to put SAA, to put Eskom back on track, power generation, our harbors. So this country can quite easily grow at 5, 6, 7% for a few years if we were to have a Nelson Mandela who engages with the private sector and gets them to commit, and foreigners will come streaming in. So that is your golden scenario. So yes, the ANC government just hasn't listened, it's ideological problem. So a new government, 2024, and it's shaping up that the leaders of those parties that we're listening to now that are coming through understand that. And so if they were to come to the private sector, a lot like Nelson Mandela did, and say, let's work together, then quite easily, you should be buying South Africa and bank shares now. Because your bank shares, remember, because the banks are the oil that lubricate the economy. And so the faster your economy grows, the more it needs banks to provide the capital to do the arrangement, to do the transaction.
And here's the FT.
Good morning from the Financial Times. Today is Wednesday, July 20th, and this is your FT News Briefing. Netflix shares rose, like a lot, even though the streaming service lost subscribers last quarter. Chinese venture capital firms have become strapped for cash. Plus, Jair Bolsonaro is taking on a very familiar face in this year's Brazilian election. We'll hear what Luiz Inácio Lula da Silva plans to do if he wins. I'm Mark Filipino, and here's the news you need to start your day. Netflix yesterday said it lost 1 million subscribers last quarter, but it wasn't as bad as what the streaming giant had predicted, thanks in part to Vecna and the kids over at Stranger Things.
Bada, boom. I was right.
Seriously, you're serious?
Mm-hmm.
This is Skull Rock, okay?
The streaming service said it would gain subscribers this quarter, but not at the pace Wall Street predicted. The focus on subscriber numbers comes after Netflix spooked the entertainment industry back in April. Then it said its decade-long subscriber boom was over. Yesterday's report revived some confidence. Netflix shares jumped more than 6% in after-hours trading. Global investors have poured a lot of money into Chinese venture capital firms, and it helped fuel the country's tech startups. But now all those pension funds and sovereign wealth funds are pulling back from China. They're worried about more government crackdowns on tech, more COVID lockdowns, and even sanctions. As a result, Chinese VCs are scrambling for cash.
What we've heard from people in the industry is that a lot of the newer funds and the smaller and medium-sized funds are having the most difficulties.
That's our China technology reporter, Ryan McMurrow.
As China just became this premier investment destination, the number of funds that were created to invest in Chinese startups and Chinese businesses just exploded over the past decade. I think from like 100 to 3,000 last year. But now there's starting to be somewhat of a fallout.
A few superstar VC firms are doing just fine. Take Sequoia China. That's the arm of Silicon Valley VC giant Sequoia Capital. This month, Sequoia China raised $9 billion to fund startups. But Ryan says the broader loss of funding to VC still hurts. That's because foreign investment has become a big part of the Chinese tech ecosystem.
These startups raise dollars from their investors, and then they usually would go list in New York or Hong Kong, sell shares, and their investors would be able to cash out outside of China. But China has made it a lot harder, and there's still kind of ongoing reforms where there seem to be still undecided on how foreign investors will be able to cash out in the future, which has made it difficult for some to invest, and then it made it difficult for everybody to get their money back at the moment because there's just so many Chinese startups that were planning to IPO this year or last year that haven't been able to.
That's our China technology reporter, Ryan McMurrow. Brazil could be the stage for an extraordinary political comeback this autumn, or at least a matchup for the ages. Luiz Inácio Lula da Silva is running for president. Again, Lula, as he's known, was one of the country's most popular leaders in recent memory. He served the country from 2003 to 2010. After leaving office, though, he was jailed on graft charges. Now, at the age of 76, the left-wing politician is taking on the current president, right-wing populist Jair Bolsonaro. Our Latin America editor, Michael Stott, interviewed Lula. He joins me now to talk about their conversation. Hey, Michael.
Hello, Mark.
So, why does Lula want to be president again?
He thinks it's, in a way, his duty. I think he's very upset by what's happened to Brazil under Bolsonaro. He feels strongly that poverty and hunger, which were two of the things he was most proud of reducing during his terms, have increased again, and that he's the right man to solve the problem this time. He also is still the undisputed sort of leader on the left. So there's a sort of consensus among all of the anti-Bolsonaro left that Lula is the best man to win.
So one of the things Lula wants to do, Michael, is restore a successful spending program. How would he make this work?
Lula believes very strongly that what he needs to do if he wins in October is repeat the success he had before by introducing what were conditional cash transfer programs. So these were payments to poorer families, which were conditional on them putting their children in education, keeping them in education, and going to regular health checks. It was a successful program in reducing poverty, but the criticism of it was that when the economy hit harder times and the money ran short, the poverty just went back up again because the payments had to stop. And of course, this time, Lula's coming in trying the same thing with an economy that's in a more difficult situation. And so there's a real question about how he's going to pay for it. Now, he says he'll do this by putting up taxes. What's unusual about taxes in Brazil is they're really loaded onto the poor because sales taxes and consumption taxes are the bulk of the revenue, and income taxes and property taxes are much lower. And notoriously, dividends pay no taxes at all. So Lula reckons he's going to change some of that, and that'll help him provide the money to run these social programs again.
Michael, what does the business community think of Lula?
A lot of the business and banking people will tell you we're not that worried. We know Lula. We think he's a known quantity. He's not going to suddenly radicalize and do something really mad. But they are concerned that the quality of policy will suffer. Lula wants to use the state to control fuel prices again, which will hurt the finances of Petrobras, the state-controlled oil company. And he's not going to be privatizing things and looking for measures to make government more efficient. So I think there's a worry among the business community that it's not going to be terrible, but it could be a lot better.
So what does Lula have over Bolsonaro? Why does he think he can win this thing?
Well, he told us that, he was a popular international figure who commanded respect on the world stage, and there's certainly truth in that. And Barack Obama described him once as the most popular politician on earth. So he's contrasting his international stature with Bolsonaro, who, in the words of Lula, is an international pariah. And again, there's some truth in that. And he's trying to reach out a little bit to the political center, trying to show that he can build bridges. So Lula's portraying himself as a figure that can bring Brazil together after a very divisive period under Bolsonaro.
And Bolsonaro, how is he responding to Lula's challenge?
So Lula is actually the opponent Bolsonaro wants. And the reason is because Lula is also a controversial character. He was jailed on these corruption charges. He was then released. And he was acquitted on some of the charges against him, but there were actually 25 separate investigations against Lula, some of which resulted in prosecutions, 3 of which resulted in acquittals. Some expired due to term limits, others were dropped, others were ruled inadmissible. There was also a ruling that some of the prosecutors were biased. But Lula, nonetheless, was president at a time when what the US Department of Justice has described as the world's biggest foreign corruption case, foreign bribery case, happened. And Bolsonaro likes that. Bolsonaro wants to paint him as a corrupt figure, as a thief, as somebody who stole, somebody who can't be trusted, as someone who's an extremist. The other thing, interestingly, Bolsonaro is doing in the campaign is he's taking a leaf out of Lula's book. He's trying to copy Lula's social program. So on the one hand, he's attacking Lula. On the other hand, he's actually copying some of his more popular policies.
That's our Latin America editor, Michael Stott. You can read about his interview with Brazil's former president and now presidential candidate at FT.com. Thanks, Michael.
Thank you, Mark.
Before we go, here's something else we'll be watching this autumn: the trial between Twitter and Elon Musk. Yesterday, a U.S. judge set the start date for October. Twitter is suing Musk to try and force him to go through with his $44 billion deal to buy the social media company. But Musk wants out. The judge said waiting a long time for the trial to start would increase the cloud of uncertainty over Twitter's business. Her ruling is seen as a victory for Twitter. Musk's team, meanwhile, was pushing for the trial next year. You can read more on all of these stories at FT.com. This has been your daily FT News Briefing. Make sure you check back tomorrow for the latest business news.
And that's all from the briefing for today. If you enjoyed this episode, please follow BizNews Radio on your preferred podcast channel to make sure that you don't miss tomorrow's show.